Today, more market choppiness ahead. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and problem news with a distinctively Australian flavour. Well, Wall Street ended lower after a choppy session on Monday, with declines in Exxon Mobil and other energy companies weighing against gains in Boeing, as investors digested the US stock market's biggest monthly gains in 2 years. The Dow Jones Industrial Average slipped 0.14%, the Nasdaq was down 0.2%, and the S&P 500 fell 0.3%. Energy fell more than 2% to lead the broader market lower, pressurised by a nearly 5% slump in oil prices after the latest data pointed to weakness in the Chinese housing market and factory activity, both stoked fresh recession concerns. And US House of Representatives Speaker Nancy Pelosi was set to visit Taiwan on Tuesday, and China warned that its military would never, quote, sit idly by if she visited the self-ruled island claimed by Beijing. More broadly, increased recession fears since the release of the mid-year outlook have prompted substantial revisions to growth in the global economy, said Morgan Stanley, highlighting the lack of a bounce back in China as one of the key drivers. The bank now sees global growth at 2.4% year over year. That's 50 basis points lower than its forecast in May. The Federal Reserve says it aims to tame inflation and cool down demand with interest rate hikes, but some investors and analysts worry that its aggressive moves could drive up unemployment and cripple the economy. And Powell also hinted last week that the central bank would begin to ease the pace of monetary policy tightening, which has drained liquidity and hurt growth markets such as crypto, to reassess the impact of rate hikes on the economy and inflation. Investors expect the Fed to still raise interest rates to somewhere around 3.3% by the end of the year. That's from about 2.375% currently, but then they forecast no further hikes after that. We project the federal funds rate to fall back from a peak of around 3% at the start of 2023 to 1.5% by 2024, Preston Caldwell, head of US economics for Morningstar, said in a report. There are still a lot of questions about whether we are really out of the woods economically, and we probably aren't, said Tom Martin, senior portfolio manager at Globalt Investments in Atlanta. We're not even close on the economic effects of the Fed raising interest rates. US manufacturing activity slowed less than expected in July, with signs that supply constraints are easing just a little. And that data came on the heels of surveys indicating factories across Asia and Europe struggled for momentum in July as flagging global demand and China's strict COVID-19 curbs slowed production. Oil prices fell on demand concerns, which in turn weighed on the energy sector. The S&P 500 energy index tumbled and was the deepest decliner among the 11 sectors on Monday. A monthly US jobs report, which will come out on Friday, will be parsed for clues about the Fed's next moves in its fight against decade-high inflation. The US Central Bank, of course, has raised interest rates by 2.25 percentage points so far this year and has vowed to be data-driven in its approach towards future hikes. Boeing gained 6.1% after reports the US aviator regulator approved the plane maker's inspection and modification plan to resume deliveries of the 787 Dreamliners. Now, it's worth thinking about this. The S&P 500 is down about 14% in 2022, but recent quarterly reports have shown companies' profits were far more resilient than estimated. Of 283 S&P 500 companies that have reported results, 78% have topped profit estimates, and the long-term average is 66%. Treasury yields, meanwhile, appear to be pricing in the increasing prospect of a recession as a key part of the yield curve. The 2-10 Treasury yield is still further inverted, which many see as a harbinger for a recession. Against the backdrop of an ongoing inversion in the yield curve, banking stocks struggled, pushing the broader financial sector more than 1% lower. Tech, which was at the forefront of the broader market bounce back since mid-June, following quarter results that weren't as bad as feared, did struggle to turn positive. Alphabet, Microsoft, and Apple were all in the red, with the latter reportedly set to kick off a four-part bond sale to strengthen its balance sheet that will support buybacks and dividends. And Twitter fell about 2% despite Greenlight Capital announcing a new stake in the social media giant, betting that the latter will emerge victorious in its court battle with Elon Musk to force the billionaire to follow through on his $44 billion deal to take over the company. And elsewhere in crypto, Bitcoin also fell around 3% on Monday to remain on course to post its fourth straight day of losses at a time when activity on its network continues to suggest that the bear market is far from over. Much of the recent rally has been driven by long-term Bitcoin investors or hodlers, those with the most conviction, but new investors hold sway over whether any move higher has staying power. The Bitcoin network remains hodler dominated, and there has not been any noteworthy return of new demand as viewed through the lens of on-chain activity, cryptocurrency research firm Glassnode said in a report. But the lack of new funds into Bitcoin isn't the only factor that's pointing to a barren environment for Bitcoin enthusiasts. Transition fees remain in bear market territory, close to the lowest level of the year. A rebound in transition fees is likely to be a signal of recovery, Glassnode said, adding that bull markets typically maintain elevated fee rates, but none of that at the moment. The latest dip in Bitcoin comes just days after the popular cryptocurrency piqued investor interest, with a notable rally to around $24,000 following bets that the US interest rate hikes were nearing an end, but now it's back down to lower levels and Ether followed suit. And here in Australia, of course, later today we'll get the RBA announcement, and we expect another 50 basis point rate hike, which will just put more pain on more households. And the prospect is still of more rate rises later in the year. Just how many and for how long, of course, is the big question. So we'll look at the RBA statement today and form a judgment at that point. It's worth highlighting that the market is still thinking around 3%, although some are calling a peak of around 3.35% before the RBA cuts later. But it must be said that the significant rise from 0.1% since May is taking significant toll on households and businesses, and economic momentum is definitely easing, as shown in the latest sales figures. So, plenty to watch out for as the uncertain times continue. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.